Welcome back, everyone. All right, let's just dive right into it. This is it, the final capstone explainer of our 8-part series on ASC 220 comprehensive income. We've covered a ton of ground together, right? From defining what OCI actually is to mastering those tricky presentation formats. But today is where the theoretical rubber meets the very stressful reality of period-end close. We're taking all those rules we learned and turning them into a practical playbook. We're going to tackle the most common mistakes, figure out how to survive the audit, and build a bulletproof control environment. By the time we finish this explainer, you are going to be fully equipped to defend your financials.
So here's our roadmap for today. We'll start with the final OCI hurdles, move into category-specific OCI mistakes, then touch on general presentation errors. After that, we'll talk about meeting auditor expectations, look at roles and required controls, and finally, wrap things up with our final takeaways.
Section 1. The final OCI hurdles, from theory to reality. Now, there is a massive contrast between theory and reality here. In our previous explainer, we looked at textbook examples, right? Mathematically pristine AOCI roll forwards, perfectly timed reclassification triggers. It all looked so easy. But over on the reality side, yeah, it's a different story. We find messy data from foreign subs, missed communication from the business about a sale, and of course, rigorous audit scrutiny. Knowing the theory just isn't enough when reality gets messy. You need to know where the traps are.
Section 2. Category-specific OCI mistakes. The highest risks.
Let's start with cash flow hedges. Mistake number 1, no inception docs. Why does this happen? Usually accounting teams are moving way too fast and think, oh, we'll just document the hedge next week. Absolutely not. The consequence there is severe. If you do that, the derivative skips OCI entirely and goes straight to earnings, instantly misstating your financials. The fix? Documentation literally must predate the hedge, no exceptions. Mistake number 2 is getting lazy and reclassifying a settlement to a generic other income line. Don't do that. To prevent a misclassification, the reclass must always go to the exact same P&L line as the hedge data. Okay, that brings us to some massive traps regarding CTA and available for sale securities. Imagine amortizing CTA over time, kind of like an intangible asset. Sounds logical, right? Wrong. It's a disastrous habit. CTA never, ever amortizes. The only time we release it to earnings is upon the full, complete disposal of that foreign subsidiary. Next up, look at the AFS mistake. A lot of teams still have this pre-CCL habit of routing all AFS fair value declines straight into OCI. But under CCL rules, we absolutely have to split it. The credit loss portion goes straight to earnings, and only the non-credit changes get parked in OCI. Finally, in our category-specific risks, we have pensions. The common mistake here is totally forgetting the year-end actuarial remeasurement. It is so easy to just confidently post the net periodic pension cost every month and think, boom, we're done. But you're not done. We have to process that actual actuarial update provided by the plan actuary at year-end. If you don't process it in the exact same period as the plan measurement date, you are looking at a material OCI miss for the year. Section 3. General presentation errors. The details matter.
It turns out, formatting and roll forwards are just as critical as the actual math. A super common error is omitting the tax effect. Remember, every single OCI item subject to tax requires a computed deferred tax, period. Then there's the terrifying scenario where an AOCI roll forward doesn't reconcile. It has to tie perfectly to the balance sheet before issuance, or you simply can't close. Also, burying OCI in the equity roll forward, that is no longer an option. A comprehensive income statement is legally mandatory. And lastly, whatever you do, avoid aggregating lines. Each category needs separate, distinct lines showing gross OCI, reclassifications out, and the net amount.
Which brings us to the ultimate pressure test. Ask yourself this. When the auditors finally arrive, what exactly are they looking for? Section 4. Meeting auditor expectations. The evidence.
An auditor's very first step is ensuring we haven't missed a source of OCI entirely. This is the completeness check. Notice they aren't checking your math yet. They are checking your awareness. To pass this, we need specific schedules ready immediately upon request. We're talking a complete list of all active hedge designations, a schedule of all foreign subsidiaries generating CTA, a full inventory of AFS holdings, and the current pension plan status. If you don't have these ready, the audit gets painful very quickly.
Once completeness is confirmed, let's see how this builds into accuracy testing. Here are the key schedules needed to actually prove your math. For hedges, they want to see the exact effectiveness methodology. For CTA, they need the foreign subsidiary financials and exchange rates to prove CTA was the correct plug. For AFS, it's proven that CECL credit versus non-credit split we talked about earlier. For pensions, they need the raw actuarial report. And crucially, and a lot of people miss this, they want a schedule of reclassification adjustments with supporting evidence like a sale confirmation. You have to prove why it moved out of AOCI.
Section 5. Roles and required controls. Building your defense. A bulletproof close relies on a clear escalation of judgment. It's like a ladder. It starts at step 1 with the team member. They are right there on the ground level doing the initial identification, classifying transactions, and preparing those schedules we literally just talked about. Step 2 is the team lead. They review those entries, actively hunt for reclassification triggers, and escalate the really tough subjective calls. Finally, step 3, the manager. Listen, the manager shouldn't be building the AOCI roll forward. Their job is approving significant estimates, reviewing the final disclosures, and giving that ultimate sign-off.
So how often do these roles actually execute their duties? Let's look at the control frequency. Notice a pattern here? Checking OCI completeness and reviewing reclass triggers? Every period. Reconciling the AOCI roll forward and checking tax effects? Every period. Testing hedge effectiveness? Yep, every period. The only major control that generally happens just once a year is the pension OCI actuarial update. Almost everything else requires your team's attention during every single close cycle.
Which brings us to this quote, which is essentially the golden rule of the handbook. OCI controls must run at every period close, not just at year-end. Seriously, we cannot wait until December to look for reclassification triggers. Or, worse, wait until year-end to realize the OCI roll forward has been out of balance since March? These are strictly period close activities.
Section 6. Final takeaways and summary. You are ready.
Look at what we've accomplished across the series. You now have the knowledge to spot and prevent material OCI calculation mistakes before they ever hit the books. You know exactly how to present a clean, compliant, comprehensive income statement with gross and net lines. You can anticipate exactly what schedules the auditors are going to demand, and you have a flawless, role-based checklist to govern the period end. You are fully equipped. So, as you head into your very next period close, I want you to ask yourself, is your control environment just theoretical, or are you truly ready to make it a reality? Thank you so much for joining me on this Explainer series, and I absolutely can't wait to see you apply this out there in the real world.